Chapter 3: Stock Valuation from the 60s through the 90s. Everything's got a moral if only you can find it. Lewis Carroll, Alice's Adventures in Wonderland. The badness of the crown can be truly speculative. The examples I have just cited, plus a host of others, have persuaded more and more people to put their money under the care of a professional, someone who knows what makes the market tick and who can be trusted to act prudently. Thus, most of us find that at least a part, and often all, of our investable funds are in the hands of institutional portfolio managers, those who run the large pension and retirement funds, mutual funds, investment counseling organizations, and the like. Although the crown may be mad, the institution is above all that. The institution is, to borrow a phrase from Tennyson, of loyal nature and noble mind. Very well. Let us then take a look at the sanity of institutions. The sanity of institutions. By the 1990s, institutions accounted for more than 90% of the trading volume on the New York Stock Exchange. Surely, in a market where professional investors dominated trading, the game must have changed. The hard-headed, sharp-penciled reasoning of the pros ought to be a guarantee that the extravagant excess of the past will be avoided. And yet professional investors participate in several distinct speculative moments from the 1960s through the 1990s. In each case, professional institutions bid actively for stocks not because they felt such stocks were undervalued under the farm foundation principle, but because they anticipate that some greater fools would take the shares off their hands at even more inflated prices, because these speculative moments relate to present-day markets. I will find this institutional tour especially useful. The Soaring Sixties, the new era, the growth stock new-ish craze. You start our journey when I did in 1959, when I had just gone to Wall Street. Growth was the magic word in those days, taking on an almost mythical significance. Growth companies such as IBM and Texas Instruments sold their price-earnings multiples of more than 80s. A year later they sold at multiples in the 20s and 30s. Questioning the propriety of such valuations became almost heretical. This price could not be justified on farm foundation principles, but investors firmly believed that the buyer would come forward eagerly to buy even higher prices. Lord Kenneth must have smiled quickly from wherever it is that economists go when they die. I recall vividly one of the senior partners of my firm shaking his hand and admitting that he knew of no one over 40 with any recollection of the 1929-1932 crashes, who would buy and hold high-priced growth stocks. But the young thugs held swayed. Newsweek quoted one broker as saying that speculators have the idea that anything that they buy will double overnight. The horrible thing is, it has happened. More was to come. Promoters eager to satisfy the insatiable thirsty of stock investors. From the space age stocks of the Soaring Sixties, creating new offerings by the dozens. More new issues were offered in the 1959-1962 period that at any previous time in history. The new issues mania rewards the dusty bubble in its intensity and also, regrettably, in the fraudulent practice that were rewarded. It was called the tronic bomb because the stock offerings often included some garbled versions of the word electronics in their title. Even if the companies had nothing to do with the electronics industry, buyers of these issues did not really care what the companies made so long as it sounds electronic, with the suggestion of the aesthetic. For example, American Music Guide, whose business consists entirely of the door-to-door sale of pornography records and players, changed its name to Spacetone before going public. The shares were sold to the public at 2 and within a few weeks rose to 14. Jack Drifts of the Dreyfus and Company commented on the mania as follows. Take a nice little company that's been making shoelaces for 40 years and sells at the respectable 6 times earnings ratio. Changes the name from Sherlock's Inc. to Electronics and Silicon Firth Burners. In today's market is the word electronics, and the silicon was worth 15 times earnings. However, the real play comes from the word Firth Burners, which no one understands. A word that no one understands entitle you to double your entire score. Therefore, we have 6 times earnings for the Sherlock's business and the 15 times earnings for electronic and silicon, or a total of 21 times earnings. Multiply this by 2 for Firth Burners and we now have a score of 42 times earnings for the new company. In the later investigation of the new issues phenomenon, the Securities and Exchanges Commissions (SEC) uncovered considerable evidence of the fraud and market manipulation. For example, some investors and some investment bankers, especially those who underwrote the smaller new issues, would often hold a substantial volume of securities off the market. This made the market too thin at the start that the price would rise quickly in the aftermarket in on hot issue that almost doubled in price on the first day of trading. The SEC found that a considerable portion of the entire offering was sold to broker-dealers, many of whom held on their allotments for a period until the shares could be sold at much higher prices. The SEC also found that many underwriters allocated large portions of hot issues to such insiders of the firm as partners, relatives, officers, and other securities dealers to whom a favor was owed. In one instance, 87% of a new issue was allocated to insiders rather than to the general public, as was preferred. The following table shows some representative new issues of this period. Let the numbers tell the story. The speculative fever was so great that even Mother's Cookie could count on sizable gain. Think of the glory they could have achieved if they had called it themselves Mother Turns, Cookie Turns. 10 years later, the shares of most of these companies were almost worthless. Where was the SEC all this time? Haven't it changed the rule from let the buyer beware to let the seller beware? Aren't news issuers required to register their offering with the SEC? Can't they and their underwriters be punished for false and misleading statements? Yes to all these questions, and yes, the SEC was there, but by law it had to stand by quickly, as long as a company has prepared and distributed to investors an adequate prospectus. The SEC can do nothing to save the buyer from themselves. For example, many of the speculatives of the period contained the following type of warning in bold letters on the cover. But just as a warning on pack of the cigarettes, do not prevent many people from smoking. So the warning that this investment may be dangerous to your worth cannot block a speculator from walking over his money if he is hell bent on doing so. The SEC can warn a fool, but it cannot prevent him from parting with his money. And the buyers of new issues were so convinced the stocks would rise in price, no matter what the company's asset or past record, that the underwriter's problem was not how he could sell the shares, but how to allocate them among the flanged purchasers. Fraud and market manipulation are different matters. Here the SEC can take and has taken strong action. Indeed, many of the little-known brokerage houses on the flanges of spectability, which were responsible for most of the news issues in the for manipulation of their prices, were suspended for a variety of speculations. The staff of the SEC is limited, however the major problem is the attitude of the general public. When investors are infused with a get-rich-quick attitude and are willing to snap up any piece of bait, anything can happen and usually does. Without public greed, the manipulators would not stand a chance. The Tronics bomb came back to Earth in 1962. Yesterday hot issue became today's cold turkey. Many professionals refuse to accept the fact that they had speculated recklessly. Very few point out that it's always easy to look back and say when prices are too high or too low. Fewer still said that no one seems to know the proper price for a stock at any given time. Synergy generates energy. The conglomerate bomb. I've said before that part of the genius of the financial market is that if a product is demanded, it is produced. The product that all investors desire was expected growth in earnings per share. And if growth hasn't to be found in a name, it was only to be expected that someone would find another way to produce it. By the mid-1960s, creative entrepreneurs had discovered that growth meant synergism. Synergism is the quality of having 2 plus 2 equal 5. Thus, it seems quite plausible that two separate companies with an earning power of 2 million each might produce combined earnings of 5 million if the business were consolidated. This mystical, surefire, profitable new creation was called a conglomerate. All those antitrust laws at the time kept large companies from purchasing firms in the same industry. It was possible for a while to purchase firms in other industries without interference from the Justice Department. The considerations were carried out in the name of synergism. Ostensible mergers would allow the conglomerate to achieve higher sales and earnings than would have been possible for the independent entities alone. In fact, the major impetus for the conglomerate wave of the 1960s was that the acquisition process itself could be made to produce growth in earnings per share. Indeed, the managers of the conglomerates tended to possess financial expertise rather than the operating skills required to improve the profitability of the acquired companies. By an easy bit of the legal domain. They could put together a group of companies with no basic potential at all and produce steadily rising per share earnings. The following example shows how this monkey business was performed. Suppose we have two companies, the Able Circuit Smasher Company, an electronics firm, and Baker Candy Company, which makes chocolate bars. Each have 200,000 shares outstanding. It is 1965 and both companies have earnings of 1 million a year or 5 per share. Let's assume that neither business is growing and that, with or without merger activity, earnings would continue along at the same level. Two firms sell at different prices. However, because Able Circle Smasher Company is the electronics business, the market offers it a price-earning multiple of 20, which multiplied by its $5 earning per share gives it a market price of the $100. Baker Candy Company, in a less glamorous business, has its earning multiplied at only 10 times and consequently its $5 per share earning command a market price of only 50. The management of Able Circuits would like to become a conglomerate. It offered to observe Baker by swapping stocks at the rate of 2 or 3. The holders of Baker's shares would get 2 shares of Able stock, which have a market value 200 for every 3 shares of Baker stock, with a total market value of 1,500. I mean $150. Clearly, this is tempting proposal, and the stockholder of the Baker are likely to accept cheerfully. The merger is approved. We have a bottling conglomerate, newly named Signon Inc., which now has 333 shares outstanding and total earning of 2 million to put against them, worth $6 per share. Thus by 1966, when the merger has been completed, when found that earnings have risen by 20% from $5 to $6, and this growth seems to justify Able's former price-earning multiple of 20. Consequently, the shares of Conglomerate need Able raise from $100 to $120. Everybody's judgment is confirmed, and all go home rich and happy. In addition, the shareholders of Baker who are bought out need not pay any taxes on their profit until they sell their share of the combined company. The top 3 lines of the table below illustrate the transaction thus far. A year later, Signargon finds Charlie Company, which own $10 per share, or 1 million with 100,000 shares outstanding. Charlie Company is a relatively risky military hardware business, so its share commanded a multiple of only 10 and sell at $100. Synagogue offers the observed Charlie Company on share for share exchange basis. Charlie's shareholders are delighted to exchange their 100 shares for the Conglomerate $120 shares. By the end of 1967, the combined company has $3 million in earnings, 4 million shares outstanding, and $6.92 of earning per share. Here we have a case where the conglomerate has literally multiplied and manufactured growth. None of the three companies was growing at all, yet simply by virtue of the fact of their merger, the unaware investors who may finger his stock guide to see the past record of our conglomerate will find the following figures.